Hi everyone, Adrian Player here, mortgage broker based up in Brisbane. In this video we're going to be talking about interest rates, we're going to be talking about the economy, we're going to be talking about economists. So what we're going to start doing is reading out my post that I put it on LinkedIn. Then I'm going to give you a little bit more clarity on what my thoughts are over the next year. Then we're going to bring it back to the context on what my clients are currently doing, because we're an investment brokerage. 95% of our clients are investor clients, so obviously we're seeing what those investors are doing every day of the week, and we'll apply that to you and where they currently sit in the market. So let's start with going through this post. Why are economists, especially the ones in the public sector and the media, wrong so many times in a row? Number one, they aren't incentivized to be right and paid well for making the right calls. Number two, no one fires them in the future for making the wrong calls or making them accountable. Number three, they are the B and C and D graders out of universities. All the best economists are snapped up by the trading firms and paid 10x what the others are paid in the public sector and the media. Number four, they are the Jim Cramers of Australia. Okay, anyone understands that reference from the American market, they'll know what I'm talking about. Number five, they don't specialize like the A graders do on one thing and master it. They are told to write these amazingly detailed reports on many things. If you've seen the back end and seen their reports, which I did on the back end inside of ComSec, amazingly detailed, a lot of thought process, and they're written in a very specific way that they're taught about on their uni courses and their master's programs. Then the minute they are on camera, they dumb it all down for a 30-second blurb and are told to act like you are speaking to a 2-year-old with their terminology and how they express that to the public. Number six, the media is owned by the billionaires and the power players in the world. Even if those economists found something that had actual value, they have to toe the owner's line regardless. So a lot of the time they won't say anything that's not in line with what the owner wants. Okay, it's good to watch the media and the news for the enlightened. It shows what horse excrement is being pushed to the public. Then you can check the markets and walk down your street, look at society to see if it's been misaligned. That's where you make the real money. So in reality, if you follow the big banks, and I'll give you a couple of examples, big banks had no idea what was happening at the end of 2019. They had no idea that we were going into a heavy recession. If you heard what the economist was saying at the end of 2019, regardless of if COVID was there or wasn't there was always going to be something happening in a 1, 2 or 3 year period. And this brings me back to everyone talking about the 18.6 year cycle. Okay, I don't believe in it. I don't agree with it. I like a little bit more simpler, easier version. Okay, there was one big event in the late 1980s, the interest rate crisis, then the 2000s, the dot-com bust, then 2008, the GFC, then 2020, COVID. And then you had a lot of half-yearly ones, and I'll give you an example. 2015 credit crunch. So you've got like a half-yearly event mainly, like a 5-year event, and then an event every kind of 10 to 14 years. So you know when to play offense and you know when to play defense. That's about it. You're never going to know exactly what the situation exactly will be. So I'll give you an example. In the end of 2019, I told my dad the music is stopping, protect your super. He didn't have he was retiring soon, so he didn't have the ability of just holding through and waiting for the rebound. So I told him to go defensive. He did, and then my thought process was that something was coming in the next 1, 2 or 3 years. I couldn't say exactly what, but now was the time to be defensive, especially if you're an old person and you can't hold all the way through and you need access to an income stream through super. And it could have been the South China Sea, could have been the migrant crisis in Europe, it could have been Trump fever in America, it could have been a lot of things, military conflict. Okay, so yeah, that's exactly what happened. So obviously it was COVID. So the thing is, you can never pick exactly what it's going to be. It's always going to be different every time. Okay, and it's always going to get big, especially if it's the 10 to 14 year event. All right, so yeah, and then you get a whole lot of 5 to 7 year events like the credit crunch that smashed the European program, the European continent. So anyone that wants to read up on that, type in the word pigs with a double I, so PIIGS. They were the nations that got smacked, had huge debt, had to get their economies into austerity, pushed by Belgium and Germany, all because they took these massive loans that they couldn't pay back and their banking system collapsed. So anyone that wants to have a good bit of reading, go and have a look at that. Okay, so that tells me that we're in now a period of a huge event where the printing happened, okay, in 2020, and then you have to wonder where the money flowed. Okay, you had huge amounts of quantitative easing, huge amounts of bond buying, and huge amounts of programs where they gave the population money in the form of JobKeeper, JobSeeker, and huge amounts of money went to businesses to keep the doors open. Now, anyone that had any sense, the main economist didn't. You can't have that amount of printing without rates going through the roof and huge inflation issues. But I think the biggest thing that I've been reading up on is the fact that this is not the 60s, the 70s and the 80s where the middle class went through boom, 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 and they got better quality of life, better quality of life, better quality of life because the interest rate went up every time because inflation went up. Then when the rates came back down, the middle class was better off, so they spent more, which means inflation went up again and it spiked 2 or 3 times. So they're talking about the current scenario in Australia being very similar to that, and I don't see that at all. It is not the same thing that is happening in this day and age, because what's actually happening is now the middle class is being squeezed and they're losing. Okay, so they've lost their disposable income, they've paid huge mortgages, they've paid the price for this period of time, and the ultra and uber wealthy, if you've seen the figures since 2020, have made so much money it's not funny. So all of the money and the flow and the wealth has gone from the middle and the lower class to the uber rich. Okay, so if the rates start dropping, and they are saying that the RBA is going to start dropping, they're doing 8 meetings a year instead of 11 meetings a year. Okay, you've got a situation where they're also doing more acknowledgement and a 2-day process for giving data and reports and stuff to the media and the public, and making themselves more accountable from a board level with the RBA compared to in the past. And she's the new head of the RBA is a nice lady, and she's pretty much said that rates aren't coming down anytime soon to 2025. When have you ever believed an RBA head, and when have we ever not followed the USA? And the USA pretty much has March, April and May, a 50-50% chance in one of those 3 months for the first rate cut. And if we don't cut and follow that, our currency is going to go from the mid 60s and it's going to go up much higher to the 70s and the 80s and the 90s if we don't follow. We're like a vassal nation of America, and to think of us any other way is a pretty stupid assessment. And the other thing is they're saying that they're keeping the rates much higher longer because they don't want the same situation happening as the 60s, 70s and 80s when the middle class boomed. Okay, but now the middle class is hurting and they will never get back to where they once were. It will get worse and worse and worse, and the middle class will get squeezed. So think about it this way. If the money flowed uphill to the billionaires and the 100 and the 500 millionaires and all the asset owners, okay, and all the disposable income that was taken out of the middle class, and a lot of them got burnt in the last 3 years, why does the media keep on saying that house prices are good so the economy is rebounding when wages are stagnating for like the last 20 to 30 years? Okay, the tax cuts. So if we want to talk about tax cuts and bracket creep, the top tax bracket, I read a study to show that it should be somewhere around 260 to 280k for it to be in line with kind of 20 to 30 years ago, and the bracket creep that's happened due to inflation. All right, and right now they're barely they're barely getting the tax rate down. What they thought was a 30% flat tax, and obviously Labor's come in and done its thing. And I'll be honest with you, I'm apolitical. I used to be a lifetime conservative liberal. Now I'm a multi-millionaire mortgage broker that has done very well in property. And all I can say is that I want smaller government, less red tape, and more government out of my face, because both parties are pretty much like the Liberal Party is not conservative anymore. They're nowhere close to conservative, and either way I don't care, because the left screw me, the right screw me, both parties screw me, so they just want to milk the millionaire. All right, so I'm apolitical. I mean, the last 3 elections, I didn't even vote, and I just paid the fine because it doesn't really matter from my point of view. I'm going to get screwed by all parties. There's no libertarian government in this space, and there's nothing that kind of advocates for what I want. Obviously, a lot of people think that I should vote Liberal because they're all about businesses, when in reality both parties much of a muchness for me. But yeah, so you talk about the bracket creep and and Labor kind of pulled back on what's happening with the tax cuts. And then everything kind of resolves around this. This is what the investors are looking at, and really we're on the edge of a huge. So if all the billionaires have the cash and the rates come down, what do you think they're going to do? They're going to get more and more and more debt, and they're going to buy more and more assets, and the middle class that got hurt is going to lose more of their houses, commercial facilities, and the stock market, and we're on the edge of like a 2 to 4 year massive boom across all sectors, and really the inequality is going to go sky high, and it's not going to go down, and our young people are the ones that are squeezed out, and I'm really talking about those 100 millionaire, 500 millionaire, and the billionaires. And the allocation of money, they're all sitting on these accounts of 5 and 6% interest rates, and they're waiting for the rates to start dropping. So I don't think that the rates are in a situation where we're going to be waiting 12 to 18 months for rates. I think it's going to be much sooner than that. And at the same time, we're not going to have the same inflation boom off the back of this, because the middle class is getting squeezed. They're much more hurt. They're not going to go out and spend as much money, which means that interest rates are going to be lower and for longer than what people think. And they're really going to have to drop those rates to try and stimulate things because of the amount of hurt in the market, which leads to more of the people with a whole lot of assets buying up more and more assets. All right, and from a client point of view, we're seeing more and more clients that are going down this route of doing trusts with accountant sign-off and recycling their borrowing power, because rates have been high, and they're looking at being high for much longer, and people want to obviously borrow a lot more to meet their goals and their life goals, and getting to a passive income target, and really getting financial freedom. and they can't do that in their personal name because they're getting maxed out. You know, if their borrowing power has been shot when the rates went up, 40 to 50% of their borrowing power went away. And you know, they know that they can't hit the goals with 3, 4 or 5 investment properties, and they want, you know, 8, 10, 15, 20, and the only way that you can do that is through trusts, having the right property selection and having the right accountant that's supportive of these kind of strategies, which we've got a lot of clients in this space doing this, and I'm doing this personally myself as well. So we're seeing a lot of people that can borrow are borrowing, and all the sharp investors are trying to load up now. We're seeing huge movements in prices in the Perth markets, 20 to 30% last year. On the Prop Track article, there was like 20 to 30 suburbs from Perth right down to the Bunbury markets that are doing that, and everyone's paying stupid money for houses right now. They're listing at 390 and they're going for 480 with 15 bidders, and people are paying stupid money. So the smart ones have either pivoted to Queensland in some areas, or they've started looking at different assets because that's where the value is at the moment. So this is just me talking about interest rates, talking about what we're seeing on the market with our clients, talking about, you know, what obviously this post and why the economists are wrong so often. And yeah, you just look at their track record over 5, 10 or 15 years. If you've been in the financial space like me for 14 plus years, and they're wrong so many times, it's not funny. And obviously the trading firms and the people in the know and the ones that actually do their analysis and keep their finger on the pulse have a very good idea on what's going to happen. All right, and I think I've got a very good idea. I've been in this space for a long time, and I hope this video gives you a lot of value. And hit the subscribe button, hit the like button, leave me a comment. And if you need help from an investment focused mortgage broker, we do this every day of the week, and we build out the large portfolios. I've got 9 investment properties myself. I'm buying a lot over the next 12 to 18 months, and we've got a lot of clients doing the same. So if you need the right structures, the right, you know, you need a broker to sit there and be able to talk about property and structures and accounting and the whys and the portfolio management and all that. And if you need a buyer's agency with obviously my skill set and you know, we've got the people that can help source those properties as well, and the finance side to give you the advice needed on building out the portfolio to hit your goals. Because at the end of the day, I mean, I can say that we build out the large portfolios, but you might only want 2, 3 or 4 to hit your goals. So that's completely fine. Everything is built around what your goals are, what your needs are, and yeah, that's what we do. So in the comments bottom below, you can book an appointment straight into my calendar, and we can have a chat and do the right thing by you and get you to your goals. All right, you have a good rest of your day. Take care. Bye.